The biggest gains have all been in AI and big tech over the last couple of years. But what happens when that AI bubble bursts? Where can investors still find 10x, even 100x opportunities? It's by a very contrarian view of the market. Joining us today is Doug Casey with International Man. He has more than 50 years of experience investing not only on Wall Street, but all over the world. And he is joining us today with a list of 3 areas of the market investors should be looking at preparing for that eventual AI bubble burst. And these areas are not only safety areas, they're also some areas that with opportunities for incredible growth stories as well that are completely separate from the AI story. So Doug, I can't wait to get into this conversation today. I want to start out by getting your take on where the AI story and that AI bubble might be right now. Again, one of my favorite things about this show for our regular viewers is that we have on lots of different viewpoints, and we just heard from several guests who said they think the AI story is still early. There's still a lot of growth ahead, at least for the next 18 months to 3 years. And yet, Doug, you have a very different view. So let us know, where do you stand on where this AI bubble is right now?
Well, first of all, let me say that I'm a technophile. It's one of the things driving the ascent of man. AI is one of the major drivers of technology itself. It's all leading towards what Ray Kurzweil called the singularity, which he thinks is near at hand when things like artificial intelligence, robotics, biotech, space exploration, robotics, all of these things are going to come together, and finally nanotechnology as well, and change the actual character of life on the planet unrecognizably from what it is today. So I'm a technophile. I really like technology, but that's different from my views on the stock market and technology. I'm a bear when it comes to AI there.
Okay, interesting. So today is a bear perspective on how these tech stocks are going to do. So when you're looking at this from a bear's perspective, is it the valuations that have you concerned? How soon of a turnaround do you think we could see with this AI bubble burst story?
I think we're not just in a bubble, but we're in a super bubble. We're in a historic mania that I think will eventually be compared to the tulip bubble or the Mississippi bubble or the South Seas bubble. It could dwarf the bubble of the U.S. stock market in 1929. So I think this is going to turn out to be something really ugly. There's an old saying in the stock market: high tech, big wreck. And high tech has been the place to be for the last few years. But that game is coming to an end. Just in the last year, the amount of margin debt has increased by 50%. The public is involved in these things. Mr. and Mrs. Buggins buying retail think they're going to become multimillionaires. Uh, they're not. Chances are excellent. Playing in this arena, they're going to lose most of what they have. It's a bubble. It's going to wind up very badly for the average investor, even though AI is going to transform the nature of the world eventually.
Yeah, we've heard people who share your bear perspective often compare this to the dot-com burst. But those companies, companies like Amazon, might have hit some major lows at the time, but have continued to go on to grow to be massive companies. So it's a bubble that burst, but will every stock lose? Or will there still be some winners that are around long-term and continue to see long-term gains for investors?
Well, that's the key question. You want to be sure that you pick the Amazon. But this is very hard to do. There are so many companies saying that they're involved in AI on some basis, but most of these companies don't have any revenues, and they certainly don't have any earnings. Like SpaceX, I'm a huge fan of Elon Musk from many points of view. But at its current market cap, $1.5 trillion or something on that order, it's selling at 100 times revenues. And it's not a SpaceX company. It's not about that company. Most of the money that he's raised for that is going into data centers and AI. And I really don't see the point of that at all. There are hundreds and hundreds of data centers that are being built in the U.S. Some of them go on for tens of acres full of electronic machinery. I've asked myself, and I've asked other people that are involved in the market and technology and are financially sophisticated, exactly how are these data centers being used? In other words, what useful purpose do they serve? And believe it or not, I haven't gotten any good answers. My answer might have been that if these data centers, masses of computers crunching data, if they were making advances in science, technology, engineering, mathematics, medicine, this type of thing, I can see it. But that's not what most of them are being used for. They're gathering data about everything, about people. That makes them very dangerous, and I don't see where they're going to be able to generate any money doing that. So as an investor, I think it's foolish to put your money into a company that doesn't have any earnings, and I don't think even has a prospect of developing earnings in the future.
I think that's very true of some of these companies that are investing so much in this data center infrastructure build out right now. But the companies that are the picks and shovels plays that those data center companies are going into debt to pay, they do have earnings. So let's talk about those really quick before we move into the three areas of the market that you say are the best to invest in with this eventual AI bubble. But I want to talk about companies like the memory stocks out there that are seeing tremendous earnings coming in right now. Companies like cooling companies, even those companies that are a part of the electrical power story that these data centers are giving a lot of money to and major contracts to for building out these data centers. Do you think there's a real growth story in some of those picks and shovels names surrounding AI?
Well, there's no telling how high a tree is going to grow, but we're at the end stage of this bubble, not in the beginning or the middle. And yes, what you're saying is correct. Investing in the companies providing the picks and shovels to the data centers and the data companies, yeah, that could be more stable. But it's a daisy chain. And if the bubble breaks for the data companies and the data centers are recognized as being a gigantic misallocation of capital, the companies that are supplying them with picks and shovels are going to crash just like they do. So, no, I don't want any part of it. There are much better places to be.
A very contrarian view from many of the guests we have on this show. And for those viewers who are watching and watch our content regularly, you might be going, this is completely opposite of something we just heard a couple of days ago. And that is the beauty of getting many different viewpoints on how to invest in the market and picking up the pieces that work for you. You can listen to Doug right now and you can hear this is a very contrarian look at the market. And that is what Doug is known for. He has a newsletter and a report called The Contrarian Insider. It's a part of his international man business. And again, he's been investing all over the world for more than 50 years and has always approached the market this way. There's a special offer for our viewers today. If you like this contrarian view, going away from the crowd and what every investor is doing in the market right now, Doug might resonate best with you. You can scan the QR code or click the link in the description. There's also a special offer just for our MarketBeat viewers today. Use the promo code MB50 for an additional discount when you sign up for this newsletter. Again, you can scan that QR code or click the link we have in the description to sign up for the Contrarian Insider Report today. All right, Doug, let's get into your list today. I want to hear about these three areas of the market you're suggesting investors should be in right now, getting ready for this eventual AI bubble burst. What's the first area of the market you'd suggest?
I can break it down into three areas, but they're all sub-areas of commodities in general. In other words, the raw materials of civilization. I can break that down into three areas. First and foremost right now would be energy companies. Back in 1980, which is ancient history to most people, energy stocks, oil and gas in particular, were about 20% of the S&P. Today, it's about 4% of the S&P. But oil and gas are more important than they ever have been in the past. And we have serious political tailwinds, such as the dust-up in Hormuz as well. There are some oil and gas companies that are yielding 8 or 10% in current dividends. And dividends, to use a religious phrase, are kind of an outward sign of inward grace. The public doesn't know or care about oil and gas. So that's where I want to be.
So when you say energy, you're mainly focused on oil and gas. What about those energy companies that are seeing that kind of uptick right now from the data center energy demand? The traditional power companies, I'm thinking companies like Eaton, Constellation Energy, other companies that have been around forever that are getting an uptick right now from the data centers. Do you think those are safe energy plays in an eventual AI bubble bursting, or could they be negatively impacted as well?
Well, I didn't mean to limit myself just to oil and gas because I own a lot of uranium stocks and a lot of coal stocks, and especially uranium. Nuclear is the safest, the cheapest, and the cleanest form of mass power generation. But there's always been a hysteria against it. Data centers, they take immense amounts of power. And the only way to do this is with nuclear. In the short run, though, coal also works. So coal is not cheap. It is safe. It's not terribly clean. So it's not just oil and gas. It's also nuclear and coal, uranium and coal. I mean, all of these things. And once again, coal stocks, especially ones outside of the U.S., are also showing dividends of around 10%, which is a sign of how unloved they are.
All right, a couple of interesting points I want to break down from what you just said. So one thing I'm hearing from you is even if that AI bubble does burst, AI will still be around. There will still be a need to power this new revolutionary AI technology that won't burst with the bubble. AI will stick around and the power will still be needed. Is that correct?
Well, I'm a great believer in the coming robotics revolution. Elon Musk may have been a bit overenthusiastic when he said that he's going to build a billion humanoid-type robots by 2030. But AI will be used to train those things and to monitor them and so forth. So, no, AI is going to be with us. It's going to stay with us. It's not just the convenience of using ChatGPT to write your term papers for you and things of that nature. It's going to have to be powered. And where is the power going to come from? You're going to have to burn things in order to generate electricity. It's going to be gas, it's going to be coal, and it's hopefully mainly nuclear. So yeah, I'm heavy in the energy stocks because they're very cheap.
I was going to say, absolutely. Nuclear stocks a year ago were incredibly hot. In October of last year, they were very fashionable. They were what everyone was talking about. And nearly every stock in the nuclear sector is on a downturn right now. Like you said, very, very low cost entry points for those nuclear stocks. And you're still believing in those long term. Before we move on to the next sector of the market that you're recommending for investors be in, are there any specific stock tickers in this sector that you are really bullish on that you'd want to share with our viewers today?
In the major oil companies, I would look outside the U.S. I'd look at Ecopetrol, which is the kind of the national oil company of Colombia. I would look at Petrobras, which is the equivalent in Brazil. And both of them can be counted on to pay dividends in the 10% area. And I think they're very undervalued. If you want to look at a small oil company, once again, being very contrary, I would go to Marin Petroleum. It's only got $1 billion market cap, but it too pays about a 10% dividend. It produces offshore oil in Africa and has lots of concessions which haven't even been drilled yet. That's a company that's got huge upside potential just based on its own fundamentals. And I'm not even looking particularly at higher prices for oil.
I also think it's fascinating that you are looking at companies specifically outside of the U.S. Oil market. Why is that? And is that true of, in general, investing for you right now? Are you looking at more companies in the market that aren't in U.S. markets right now?
Well, I've always been internationally oriented. I've traveled to 155 countries. I've lived in 10. And even now, half the year, I live in Argentina and Uruguay, even though I'm in the U.S. at the moment. So I'm very eclectic. I'll go anywhere where I see value. And frankly, I see a lot of value more outside than inside the U.S. But we can even look at Canada, for instance. I mean, if we go to Alberta, which is the center of the Canadian energy industry, there are lots of small oil and gas companies up there that are yielding 5, 6, 7% in current dividends. So if Colombia and Brazil and Nigeria scare you too much, you can find excellent value in Canada and Alberta even.
And hence the name of your business, The International Man. This now makes a lot of sense and also really truly speaks to your contrarian viewpoint on investing not just in those popular headline-driven U.S. companies, but really looking at broader investments all over the world. So I love having you on the show, Doug. This is really interesting, a great first point, and a lot of really interesting names there. Let's move on to the second area that you're looking at for investors to move towards if they want to prepare for the eventual AI bubble burst.
Okay, well, now we have to talk about the mining business. And I've been involved in the mining business for most of my investing life. It's a stupid business to be involved in, quite frankly. You're playing around with big yellow trucks in the dirt. Kids aren't interested in the mining business, not when they can sit in their basement and play with a computer. I've always been a bull on gold and silver in particular because they are money in its most basic form. This is a central problem that we're confronting right now. The fact that the dollar is an IOU nothing on the part of a bankrupt government. This is why gold is currently at $4,000 an ounce. Okay. I'm not buying gold and silver right now as a speculation because from being underpriced relative to everything else in the world, cars, clothing, they're about reasonably priced, in my opinion, where they are right now. But the stocks of the companies that mine them are very, very underpriced. The all-in sustaining costs of mining an ounce of gold, okay, that's everything from soup to nuts to planting grass on the mine when it's out of business. And all mines go out of business because it's a diminishing asset when you're mining something. Right now, for the first time in many, many years, owning a gold mine is like owning a gold mine. They're making tons of money at this point, but fund managers and the public in general either don't know or don't care about it. I think eventually, when their attention is directed to the mining sector, which is just a teeny-weeny portion, only 2% of the S&P, and those are just the big ones. I'm more interested in the smaller ones that are still run by founding entrepreneurs. And I see the potential for 10 to 1 on the group as a whole. I suspect some of these stocks are going to go 100 to 1. In the past, I've owned a couple of stocks that went 1,000 to 1. I'm not talking over the course of a lifetime. I'm talking over the course of a 5-year cycle. They're very, very volatile, much more volatile than any other sector of the market, actually.
Yeah, a couple of follow-up questions here. Again, it sounds like you've had a ton of experience in the sector. I want to hone in a little bit on that risk that you mentioned. The volatility is absolutely present for anybody who's ever invested in these kinds of mining stocks. And not only volatility, it takes a tremendous amount of capital to get these mines up and running and to get them to the point of profitability. And sometimes these companies just don't make it. You have investors who will invest in a company that just goes bankrupt and never gets to that point of profitability. So that risk also exists in this sector, right?
It happens all the time. I mean, look, Mark Twain is famous for having commented, a gold mine is a hole in the ground with a liar at the entrance. So yes, small mining stocks are famous for fraudulent promotions and high hopes that go bust. Everything that can possibly go wrong will go wrong on steroids in the mining business. Volatility and risk are two different things. And right now, as cheap as they are, I don't see much risk. Because these stocks are so small, means that when they move, they really, really move. That's the advantage of small cap stocks. We're not talking trillion-dollar market caps here. Sometimes we're talking nano caps.
Interesting comparison about volatility versus risk. I think it's less risky if you know what you're doing. And for many investors, they maybe stayed away from mining stocks because of that volatility, because they don't understand how to spot those small mining companies that have potential and the ones that are just selling snake oil, as you said. What are some of the specific stocks out there that you are watching in those small mining names? And as you talk about those stocks, I'm also curious to hear what you look for. What makes a company stand out to you as a good possible investment and not that more dangerous snake oil one?
Well, I hesitate to mention any particular stock simply because they are so tiny. And you even have 10 or, God forbid, 100 viewers that pile into a stock that I might mention. You might double it for no good reason at all. So I don't want, I just simply don't mention these small stocks in public, quite frankly, for that reason, because they are so small and so volatile. As far as how to select them, years ago I developed a mnemonic. I call it the 9 Ps. So I've got 9 things that I look at when I'm looking at these stocks. The first thing is people, because good people make for a winning proposition. Bad people can screw up and will screw up anything. So I like to get to know the management of the company and see that they've been successful in the past. Second P is property. And here it's helpful to have a little bit of a background in geology so that you understand where deposits are likely to be and how they're going to be found and analyze the methods of determining whether there might be a deposit there and so forth. So third is financing, spelled with a PH. Can they get the money and can they get enough money? Because one of the problems with the mining business is it is very capital intensive. I mean, you spend millions of dollars on an Easter egg hunt looking for a deposit. And even if you find a deposit, that's when your troubles start because the chances are 1,000 to 1. It'll ever be a mine, but it'll cost you millions more to determine that it can't be turned into a mine. Another P is politics. The government is rarely your friend. It's always your enemy when you're playing around in the dirt looking for these things. So some jurisdictions are much better than others. Some are absolutely terrible. And you have to consider that. So and there are 5 other P's, but why go through them all right now? We have a video program called expertsroundtable.com where we get together 12 or 15 guys that are expert in mining, and each time we take apart a company. Good investment, bad investment. I think your listeners might tune into that to get an education.
Well, and if you do want to hear some of those specific mining names and the companies that Doug is talking about, he does share those with his subscribers, again, at this Contrarian Report and on his International Man company. So if you want access to that and some more of the training on investing in these types of companies, you can scan the QR code or click the link in the description to get that special offer, again, from Doug and his team at the International Man. There's also a special offer just for our MarketBeat viewers today. Use the promo code MB50 for an additional discount when you sign up for this newsletter. So again, take advantage of that special offer if you love hearing from Doug and the wisdom that he has to share from all of his experience in the market. All right, Doug, let's move on to that last sector. I know you mentioned commodities in the first sector you talked about. Let's continue that commodities discussion a little more.
The last area is not going to be for stocks, really, but we're talking about commodities. And I would draw your attention to the agricultural commodities traded on the futures exchange. Now, there are 10 agricultural commodities traded on the U.S. futures exchanges. But what interests me right now are the grains, which is to say corn, soybeans, wheat, and rice. And they're all, once again, extremely cheap. 60% of all the calories that people eat worldwide are from those 4 commodities. And right now, all of them are at break even or worse for the farmers. There's good reason to believe that we're going to go into a cyclical commodity bull market from very low levels right now where they are. So I'm long all 4 of those at this point. You can go long via ETFs or you can go long directly in the futures market.
Okay, this is so interesting. A very different type of investment. We've never talked about trading commodities in the futures market on this show before. So I want to dive into the how a little bit more. I also love that you mentioned the break even for farmers, because if people have been watching MarketBeat long enough, they know we're headquartered here in South Dakota. So we're very familiar with that agricultural farming story and the impact it's having on that ag community. So that story tracks very well. The ag commodity prices are quite low right now. But let's talk about logistically. If you're interested in this futures market that you're talking about, how do investors go about doing that?
Most people should stick to the ETFs. There's an ETF called CORN. That's its symbol, logically, corn. And it's the same for wheat and soybeans. And so I think if you just buy those at this point, they're going to treat you very well over the next couple of years. That's entirely apart from the fact that there's a worldwide shortage of fertilizer looming, partially because of the closure of the Straits of Hormuz. And incidentally, I don't think they're going to be opened up anytime soon. You want to capitalize on higher food prices, buy an ETF for one of those things. I just draw your attention to the those four big commodities.
Again, very interesting, completely different area of the market for investors to be looking at right now. And if that AI bubble burst does come, completely different than the tech-heavy conversations we normally have. One thing after investors who have been very heavily in tech for the last couple of years, they're used to those outsized returns. We've talked about stocks that have had 1,000% gain in 1 year, 700% gains in a span of a few months. So when investors get used to those kind of increases, it can be hard to look at some of these other strong and steady stocks. So, talking about commodities in particular, and these ETFs you mentioned that are connected to corn or wheat and soybeans, what kind of returns can investors expect with that? And maybe make a case too for why those are the kinds of returns investors should also be looking for, and not just those 1,000% gain stories in the span of a year.
Well, as I tried to emphasize earlier, this is a time when the market is much, much riskier, the general market. In fact, the world economy is much, much more at risk than it's ever been in my lifetime anyway. So you want to de-risk. I'm not sure you want to own dollars because dollars are being printed up by the bushel basket by the Federal Reserve just in order to finance the U.S. government's deficits. So you can't be in dollars. You can't be in the stock market generally, certainly not in tech stocks where all these people are today. You don't want to own bonds. They're a triple threat to your capital. The interest rate risk, I think interest rates are headed up. Credit risk, the danger of default is great. The currency risk, the dollar is going to lose value radically. So where are you going to be? Where are you going to put your money is the question. Generally, I come back to the raw materials of civilization. They're not going away. They're all ultra cheap right now, below costs of production in many cases, farm commodities in particular, at or below. That's where I would be for those reasons, not just reasons of upside potential, for reasons of safety as well. Where are you going to put your money?
I love this conversation on this very contrarian look at how to invest in this market right now. Again, plenty of guests come on the show and talk about how bullish they are in the future of tech, and that the tech growth story, the AI growth story, is not over yet. Again, I think it's important for investors to hear from many different perspectives on investing in the market. Do your own research and come up with your own conclusion about what kind of investing you want to be a part of. If you want to hear a completely different take on where AI and tech stocks are headed, make sure to watch this interview talking about the pullback we saw last week in some of these big tech names, and what another analyst has to say about where they could be headed in the near term and the long-term future. You can watch that full interview here.